Stock markets are down a lot again today. It seems likely that we will see a bear market, that is, stocks falling more than 20% from their previous peak. We see the CBOE volatility index, which is a measure of how scared Wall Street is, spiking up. And the reason for this is that initially investors may still have held some hopes that there could be de-escalation. What we've seen is the opposite. We've seen China retaliate, and now we even see the US saying they might retaliate to China's retaliation. The market is thus pessimistic. It believes that the current situation is very likely to end in a recession. And of course, there continue to be doubts about the growth outlook for the US economy, which up to this point had outperformed. Another source of pain for equity investors is that bond yields have not significantly fallen, particularly when we look at the 10-year maturities of the treasury market. Usually, at least something that comes out of these economic fears is that because investors believe that the Federal Reserve will cut rates, at least bond yields go down and they don't pose as much of a competition for stocks. But this hasn't been the case. We've seen the 10-year yield on the treasury bonds remain around 4%, and actually it has increased a little bit today. And that seems to be because even though markets do think that the Federal Reserve, despite the indications it has given so far, might slash interest rates in response to the possible recession, they also think that in the future they might have to maintain a pretty restrictive monetary policy in inflation adjusted terms going forward.